Welcome to Catalyst. I'm Madison Mills. 30 minutes into your U.S. trading day, let's get you a check on the three catalysts we're watching this hour. First up, trade uncertainty looming over investors as China threatens fresh retaliation. We'll break down what's at stake. Plus, earnings season shifting into full swing with tech giants out with results this week. We'll break down what to watch for. And Fed independence front and center as President Trump calls for lower rates from the central bank. We're going to break down what it means for investors in the so-called Sell America trade. Half an hour into the start of U.S. trading, let's get a check on the markets here. Taking a look at the major averages, you've got your S&P 500 off about 1.8%. Your tech names taking the majority of the heat this morning here, down a little over 2%. Tesla among the biggest losers of the Mag 7 this morning, down a little over 5% as we head into Tesla earnings later this week. But I do want to flip the board over to the bond market here. We saw the 2s, 10s curve hitting a high in this cycle earlier this morning. You've got your 10-year up just about 4 basis points, same with your 30-year yield up. And it's interesting to see Treasury selling off as we're seeing the dollar selling off as well. We typically don't see that action occurring at the same time. This is part of the Sell America momentum that we are starting to talk about a little bit more this morning off the back of those questions about the Fed's independence. But finally, let's take a look at Bitcoin. Perhaps the risk on sentiment continuing in the digital currency this morning, up a little over 3%. I do want to welcome in Ann Berry, the founder of Threadneedle Ventures, who is a 15-year veteran of private equity deal making. She joins me for the hour here. Ann, always great to speak with you. I know that among your many years of experience here, one of the things that we love to talk to you about is your experience in boardrooms. And you speak to investors, speak to executives about how they are dealing with tariffs at the moment. What are you hearing them say?
Well, everyone's trying to figure out what to do. And the challenge with that is, Maddie, there is no real clear answer. Mm-hmm. And you have CEOs coming together and saying, our customers are coming to us saying, what are you going to do about tariffs? We're going to our suppliers saying, what are you going to do about tariffs? But in terms of an action plan until there's clarity on where these tariffs will land, it's an in-between, which is planning for the worst, hoping for the best, really being able to do nothing in practice until there's clarity. And boards and management teams and markets hate when the answer is do nothing for a period of time.
And they hate uncertainty, which we've heard time and time again. And I think one thing that adds to uncertainty is a question in the room about who the Fed chair is going to be. And this is the topic du jour of this morning's trade right now, especially as we continue to see a weaker dollar, a sell-off in treasuries. Just your thoughts, Ann, on the independence of the Fed and how much of this is noise right now about Fed Chair Jay Powell?
This feels like round 2 of an old fight.
Yeah.
Right? So we have seen President Trump and Fed Chair Jay Powell be at odds with each other from a policy perspective before. We saw it in the first administration. Mm-hmm. We knew in the run-up to the election, we knew post the inauguration that this was going to be an issue that was going to come up. I salute Fed Chair Jay Powell for his fortitude and his consistency in saying the Fed should remain independent. I'm not going to go anywhere. I will fight till my last breath to make sure I stay in my seat. Personally, I think it's critically important that we have an independent Fed.
Yeah.
Now, that being said, do I think that President Trump's going to rattle his saber right up to the day that Jay Powell finishes his term? Absolutely, but this is just so unhelpful at this moment when we don't need another battlefront for the US to be fighting on. We're already going after tariffs, we're already going after domestic policy. It feels like this one is one that does not need to be rattled right now.
And you certainly don't need the US mentioned in the same sentence as Turkey, and I'm hearing that more and more this morning. I was living in the Middle East when the independence of the central bank in Turkey was put under question, and it was interesting to see just obviously the record-breaking inflation that happened there. That's obviously an emerging market, but now we're hearing continued questions about whether the US is on a path to returning to an emerging market, and that's certainly a very hot take that we're getting from some folks who maybe want attention for their calls at this moment. But the fact that that's a question that's even being asked, you don't want your central bank compared to that of Turkey's in this moment. We're already fighting inflation.
That is definitely a catastrophic case scenario and a catastrophic case narrative. But when you look at what's going on with safety assets with gold, for example, maybe big coins and an ancillary of that, the markets are kind of saying we're not as sure as we were that this isn't going to be an issue. Right. And that's really terrifying. And you see the sell-off on the dollar as well. So this idea that the US assets have been a safe haven, the idea that you can count on America, you know, that this is not a good spot to be in terms of narrative. And in terms of, I've just come back from a trip overseas. No one's betting against America, but no one's saying, oh, we should be going all in over there right now either.
Right. Right, that's exactly what Krishna Mamani over at Lafayette College was telling us earlier in the hour, this question of, okay, well, you don't want to fully divest from the U.S., but also if you think you're going to have a recession, you don't want to be super long the U.S. either, so kind of a hold cash and bonds perspective, and I know you've been talking about holding cash for quite a while, Anne.
Yeah, and you know what, there's something you and I talked about before, Maddie, which is this whole idea of there is no alternative, the Tina trade, which came up during COVID, right? It came up again in the run-up to the election. And I think the markets are sitting there going, actually, maybe we do need to find an alternative. Maybe we are forced to go and look overseas, whether it's a diversified overseas stock portfolio, whether it's moving more into commodities, whether it's moving back into gold. But this Tina narrative, I think, has got people really spooked. And people are trying to look behind, our asses to try and find other avenues.
Right, absolutely. It's a really, really great point, Anne. Thank you so much. Glad that we will have you for the whole hour to ask questions too, but also to get your questions to our guests as well. I'm sure you'll add fantastic context in those conversations, but we want to continue the trade war conversation. As tensions mount, China is warning its trade partners not to cave under pressure in tariff negotiations with the U.S. China's Commerce Ministry saying if any countries agree to deals that would hurt Beijing's interests, they will, quote, resolutely take countermeasures in a reciprocal manner. Joining us now with more, Scott Kennedy, the Senior Advisor and Trustee Chair in Chinese Business and Economics at the Center for Strategic and International Studies. Scott, great to have you here this morning. The president awaiting a phone call from Xi Jinping. I'm curious, how likely is it in your view that we see blinks from China before the U.S.?
I think the chances of that are pretty low for China to blink first. I do think that we'll see both sides talk to each other soon. Already at the staff level, there have been communications. I don't think we're going to see President Trump and Xi speak directly in the next few weeks because the U.S. is focused primarily right now on trying to reach trade deals with other countries, partly as a way to make China feel more isolated. But China, as they say, is in this to the end because this isn't just a trade spat now in which they could just negotiate a few market access agreements and purchases to make this go away. This really gets to the heart of the Communist Party's hold on power. Xi Jinping has to look like he's defending Chinese interests. And they have a bunch of staying power. China's got a lot of fiscal space. They've got better tech than they had before. They do have strong relations with a lot of other countries. And so I expect them to stick with this for quite some time.
So then where do you see this heading? Obviously, you mentioned that you expect China to stick with this for a long time. There have been sort of sectoral negotiations, at least from the White House, talking about a reprieve for some of the automakers, maybe for some of the individual tech companies as well. How do you see that playing out?
Yeah, there are a variety of areas where this could escalate into finance. For example, if the U.S. decides to kick those 286 Chinese companies that are listed on American securities markets off them, pull the licenses of Chinese banks. The Chinese could do the same with American financial institutions in China. You could see a variety of different ways that this could escalate. But I think over time, the two economies are going to feel the pain, particularly in the United States, because of our very large financial markets. The U.S. already backed off the Liberation Day tariffs against others. They've made exceptions to IT products from China. So I expect at some point, the U.S. is definitely going to want to settle with China, and the Chinese are going to want a deal as well. Is that going to be a deal that really solves the real challenges we have from Chinese state intervention in their economy?
Yeah.
No. But will we get to a more stable place than we are right now? I think at some point we will.
And Scott, my guest host, Ann Berry's got a question for you, Ann.
Scott, where do you think, even when the tariff noise dies down, from a regulatory perspective, where do you think some of this sticks, whether it's a limit on the number of chips that can be exported to China, whether it's things like TikTok and where that lands? What do you think are going to be the longer term consequences here?
Well, I think the economic security restrictions that the U.S. has been imposing on China over the last 7 to 8 years, that train has left the station, and those are going to continue to be escalated. The Biden administration called that small yard high fence and focused primarily on advanced semiconductors and semiconductor equipment. The Trump administration has continued to expand those restrictions also into less advanced chips, legacy chips that don't need that are used quite broadly, but aren't is used in military applications as much, but we're going to see that in the automobile sector, restrictions for data security, and others. So I think the tech restrictions are going to continue to expand regardless of where this trade spat turns out.
But how much power does China have to really ding the U.S. large cap tech names?
China is a monster market for many American companies, and they can impose a lot of pain if they choose to. I don't think they want to. They want those companies' investments and partnerships in China and in third markets. But if they decided to, they could make life much more difficult for Tesla in China, for Apple, for some other companies. They've already launched investigations into Google, into DuPont. Yeah, China doesn't have the direct level of leverage that the U.S. does, but it can impose pain. I think the main way the Chinese can hurt the U.S. is by fighting back in general, looking like they have staying power, which makes American financial markets less stable. And we've seen that over the past few weeks. I think that's their main strategy, to try to get the U.S. to want to get to a deal.
Scott, in our final minute, just curious what you think about the push from the Trump administration to look into ways to potentially fire the Fed chair. Obviously, legal battle to come on that. But how does that sort of noise happening stateside impact the tit for tat with China?
Well, if the president was able to do that and he got a Fed chair that was more amenable, that person may be able to lower interest rates or do other things that try and boost the short-term prospects of the American economy and make the U.S. have more staying power. On the other hand, it might inject a lot more uncertainty in which markets would react negatively. And as we've seen, market reaction is central to how the Trump administration judges their own staying power in this. So I'm not sure that changing the Fed chair actually makes the U.S. position relative to China that much stronger. It might actually weaken it.
All right, Scott, we got to leave it there. Thank you so much. Appreciate it. And Ann will stick with us throughout the hour. I do want to check back in on U.S. stocks. Losses accelerating as President Trump renews his push for the Fed to cut rates, posting on Truth Social this morning, pushing the Federal Reserve to cut interest rates. This follows after the president had said last week that Fed Chair Jay Powell is too late, that he is often too late in the president's words, and pushing for what he called, quote, a termination. That use of the word termination in his Truth Social post last week being the key focus this morning, that perhaps is leading to this question about whether or not we're seeing a sell America trade. If we have the bond market, I do want to flip the board over there because we're seeing that 2s, 10s yield curve continuing to steepen here. Interesting that at the front end of the curve, we are seeing a little bit of a bid, perhaps that front end of the yield curve combined with gold being that safe haven for investors this morning, as investors are getting out of those more long-term treasuries amid some of those questions about the safe haven status of America moving forward. Of course, we will continue to cover all of that and more for you this morning. We've got all your markets action ahead, so stick around. You're watching Catalysts. As earnings season is kicking into high gear with big tech now in focus, analysts are getting a bit pessimistic. According to Morgan Stanley's Mike Wilson, profit outlooks being slashed amid fears of a severe economic slowdown. Still with me for the hour, we've got Ann Berry, the founder of Threadneedle Ventures. Ann, great to get a chance to speak with you on this. So I thought what stood out to me about this note is the recession commentary from Mike Wilson, saying if we avoid a recession, then we made our lows 2 weeks ago and we're past that. If we do have a recession, then we still have more pain to go. And obviously he's talking about this in the context of earnings revisions coming in just a bit. How do you think about a note like this as we do head into a big week for big tech earnings?
I think it's really indicative of what companies have to do themselves in terms of communicating their stories. And I'll give you one specific example, Maddie, which was United. Did you see United last week put out projections that said, in the event of a soft economy, scenario A, in the event that it's better than expected, scenario B. It's pretty unusual that you see companies hedging their bets like that and saying, here's a slew of different options. This note from Morgan Stanley's Wilson is effectively doing the same thing, and I think it's a sign for this earnings season to come.
And it was also interesting that he talked a little bit about international stocks as well, and whether or not international earnings are also going to start to follow the U.S. by coming in a little bit. That kind of fights back against the narrative that, oh, we can seek safety in international stocks. Well, can you? And this morning, what we've heard a lot is the, to your exact point earlier, no alternative, right? Like, can you really find safety in stocks anywhere right now? And should you just be in cash and bonds at the moment, depending on your personal investment portfolio?
You know, there's an old saying which is going to age me, which was when America sneezes, the rest of the world catches a cold. And then the same was true of China. Like, we're talking about the two biggest economies in the world completely at odds with each other and now trying to seek out alliances that could change a lot of the supply chains as we know it, and will certainly change demand dynamics as we know it. So yes, diversifying into international diversification is always a smart thing to do. Yes, looking into other asset classes. But at the end of the day, at this moment in time, our global economy is so interconnected, it's so interrelated. These trade flows are so entrenched at this point that the idea that there is any safe haven, for me, feels like a bit of a false premise.
Yeah, it's certainly in a moment with so much uncertainty, the only certainty we have is that we don't have any idea what's about to happen, whether it be the Fed chair or on tariffs. So definitely that is something that we expect to continue. Anne, thank you so much. As always, you're going to stick with us moving forward for the next 40 minutes here. 120 S&P 500 companies set to report quarterly results this week. That'll include Tesla, Chipotle, Boeing, and Alphabet. Just 12% of the S&P companies have already reported first quarter results. Data from FactSet showing 71% of those companies have reported earnings per share above Wall Street estimates, but that's actually below the 5-year average of 77%. Joining us now to break down some of what we can expect moving forward, Yahoo Finance contributor Hope Kane. Hope, it's great to see you. Thanks for coming on this morning. Hope is the founder of Macro Talk News. And Hope, I'm curious, what are the signals that you are watching out for this earnings season? What are you going to be watching for this week?
Thank you so much for having me. I love that my first report is with you, Madison. And as a journalist now focused on the macro themes, it's all about outlook this quarter. It's usually, of course, about outlook, but it's even more important this earnings season because you've seen so many companies become more hesitant to talk about how they're approaching the uncertainty. So whether they're going to give guidance, and if they give guidance, are they confident? Do they sound like they have a plan? Those are some of the signals that I'm watching for, because as we move forward through the rest of the year, if companies are not putting out guidance, that suggests a lot of things. They might be very cautious about what they want to put out, because putting out a bad guidance number is even worse than giving no guidance. And if you think about how companies are trying to plan, that gives a signal to the rest of the industry of how they're doing. So I know Anne talked about how United gave two different potential pictures. I think that's really smart because it goes to show they're thinking about the scenarios. They want to give transparency as best they can, and they're not doing what Delta did, which is to withdraw some of its guidance.
And Hope, this week we are going to start to hear from some of the big tech names, obviously Tesla and Alphabet, but also some other tech names like IBM are in the mix as well. What is the single biggest earnings print that you're going to be watching most closely this week?
I mean, you hate to say it, but you know it's always Tesla, right? You've got Tesla, you've got Alphabet coming off its antitrust loss. For Tesla specifically, I was going through Say Technologies platform. They are a platform that aggregates retail shareholder questions. And one of the ones that was voted to the very top from a retail investor is, did Tesla experience any meaningful changes in order flow rate in Q1 relating to all of the rumors of brand damage? I know you guys have been talking about this. This is a big concern for the company going forward. Not only are they dealing with the effects of the tariffs, of supply chain disruption, the brand perception around the world. You're seeing the attacks on Tesla vehicles, dealerships and parking lots here around the US. I mean, that's having a negative impression on future buyers, on current buyers. So the fact that this is one of the most top voted questions, I would be very curious to see how Tesla leadership answers this on the call.
Hope, we're also getting results from some consumer packaged goods companies this week. We've got PepsiCo, we've got Procter & Gamble. What about the focus there, and what is this going to tell you, do you think, about the state of consumers' wallets right now?
So CPG is a huge sector to watch when it comes to earnings. And I think for consumers, we know that if companies are currently raising their prices, that they are taking advantage of the situation. So what I'm most focused on now when it comes to the earnings coming out of CPG, consumer products writ large, is how they're managing their margins. If you're moving supply chains, if you've got to reroute some of, let's say, your oatmeal, if you're a food maker of Quaker Oats and the like, then you're going to have to pass that on. But do you pass it on in a way that will turn consumers off? So the balance between margins and loyalty is going to be very critical. Again, because some of these tariffs are currently on a 9-day pause, I don't think we're going to have all of the answers. I don't think the leadership on the calls will give a lot of detail. And if they do, it means that they are really resilient. They're very agile. And these two themes are also really important right now, because if you know that a company has an agile strategy, it means that they've been really thinking about it, running simulations on how they can move things around, and that their brand is maybe strong enough to withstand the antagonism really now in the markets, tariffs, inflation. I mean, these of course are going to be the inputs into the earnings, but they're not the real story. The real story is how resilient are these companies, how agile is their strategy, and if they're confident enough to give any outlook, and what does that outlook actually sound like?
Hope. We're also going to be getting results from some defense and aerospace companies, many of which rely heavily on federal funding for government contracts. Given everything that's going on in DC right now, what are you expecting to hear from these names?
I mean, the same thing is if they have a diversified strategy. Are they agile enough? You have GE Aerospace reporting, you have Boeing reporting. I mean, these companies have large businesses. So maybe, for Boeing specifically, we know they have other issues they've got to resolve and answer for. But with the budget cuts, with the military spending in focus, that's going to be really key for investors to understand is how impacted will they be if those dollars shift over to smaller startups. And don't forget, government contracts, I mean, they really affect government contract workers. And we know in the labor market, that's been a big question mark, is how those workers will be affected ultimately.
Hope, great to have you and your insights. Thank you for joining us. And I know you're going to stick with us for more insights moving forward. So we're excited to have you. And Barry will stick with me for now as well. I do want to check back in on those losses we are seeing accelerating. Your S&P 500 down over 2%. Your tech-heavy NASDAQ down over 2.5%. This loss accelerating here as President Trump renewing his push for the Fed to cut rates in a post on Truth Social here. And what's interesting to me is that the traditional correlations are really breaking down here. You're seeing a risk-off trade in stocks. You're not necessarily seeing a bid in treasuries off the back of that. You've got, if we can flip the board over to the bond market, you'll see that as we move further out the curve, you're continuing to see increases in yields off the back of some of this Sell America trade here. I do want to take a look also at the U.S. dollar, which has been declining over the course of this morning. You can see those declines continuing. The U.S. dollar down against every major G10 currency as of this morning. Well, coming up, we're going to take a look at trending tickers. We'll give you the news behind some of those big moves next on Catalysts. It's now time for some of today's trending tickers. This morning we are watching NVIDIA, Hertz, and Strategy. First up, NVIDIA CEO Jensen Huang meeting with Japan's Prime Minister, pushing the country to generate more power to fuel AI. Huang says the country needs to build new infrastructure to meet artificial intelligence demands, calling energy essential for all industrial growth. And Barry, still here with us to provide a little bit more context. And how are you thinking about NVIDIA right now?
Well, I think Japan's generation of power is the least of NVIDIA's issues, to be perfectly honest with you. And sidebar, Jensen Huang actually did shed his leather jacket for this meeting.
So important indicator.
Different vibe. Look, I think NVIDIA has got the elephant in the room is curbs on the number of chips it can send to China, issues on how it's going to stand behind its investment strategy in the United States, given all the uncertainty we have right now. So, look, NVIDIA's been punished. I've got NVIDIA stock. A lot of people do. It's great that Jensen Huang's out there sort of keeping on, but I think he's got some real domestic issues to focus on.
Yeah, I heard an investor last week say you're investing in management teams, not companies right now. So If you believe in Jensen Huang, maybe you think there is that recovery there. Another name we're going to talk about, Hertz. Bill Ackman's Pershing Square Capital Management taking a nearly 20% stake in the car rental company, betting on its turnaround plan. Ackman believing the company can capitalize on a potential rise in used car prices due to President Trump's tariffs on auto imports, calling Hertz, quote, uniquely well-positioned in the current tariff environment. You see stocks selling off just a touch this morning, but that comes after, I believe, an over 50% gain in the stock, 2 days of back-to-back double-digit gains. And what's your take?
Do you know, I have a slightly controversial take on this. I've said this on Yahoo before. I actually like following activist money. And when you get savvy investors like Bill Ackman, who see the potential for an operating turnaround, the management team, whether new or replace, or incumbent, can go execute against, I find that quite interesting. So, I'm following. following this one. I do think that there is something sort of lurking in there. I'm not sure it's all about a tariff-resistant play. I think there are other levers that this company is going to have to pull to turn this around, but I think there's an interesting thesis underlying it.
All right, really important indicator there. I like that. That's good. Finally, Strategy getting a new buy rating at CTBC Securities due to its aggressive Bitcoin acquisition strategy and the potential that has for more growth to come. The company did buy more than $555 million worth of Bitcoin over the course of the last week, bringing its total Bitcoin holdings to more than $36.4 billion. Shares of Strategy up nearly 4% this morning. Yeah,
Incredible.
Yeah. What are you thinking about Strategy at the moment and Bitcoin in general, I guess?
Okay, so Bitcoin, I'm a very late adopter, and I've been very sort of, I own this, right? I did not touch Bitcoin for a whole host of reasons until January of this year, when I thought if there's an administration that's going to try and support more mainstream Bitcoin adoption, it's going to be this one. So I bought a very small amount of Bitcoin. This whole thesis that you've got companies taking Bitcoin and using it as a reserve currency, right? So go buy Strategy shares instead of going buying Bitcoin itself. I'm not quite there yet.
Yeah.
I'm still a couple of steps behind. You know, I'd like to see businesses that have got sort of more fundamental operations behind them than simply basically trading a new commodity.
Right. You say behind, I say strategic.
There you go.
You're thinking
There we go.
it through in a very smart way. Our investor audience could take a note from your book. And also to mention, you can scan the QR code on your screen to track those trending tickers. That'll be at the Yahoo Finance trending tickers page. Stick around for more catalysts when we come back. U.S. stock losses accelerating as President Trump renews his push for the Federal Reserve to cut interest rates. You've got your S&P 500 down a little over 2% at the moment here. You've got your tech-heavy NASDAQ off just about 2.5%, with tech taking it all on the chin for us this morning. Interesting to see consumer discretionary and information technology, the two biggest laggards right now in the S&P 500. No surprise, Tesla being the biggest responsibility bearer for the moves down that we're seeing in consumer discretionary this morning. That stock off a little over 6% right now. Well, President Trump posting again on Truth Social this morning, calling Fed Chair Jerome Powell too late when it comes to cutting rates. Trump has repeatedly threatened to fire Fed Chair Jay Powell despite legal protections. Here with more on this, Yahoo Finance Fed correspondent Jennifer Schomburger. Jennifer, talk us through what you are monitoring this morning as this continued back and forth between the president and the Fed chair plays out.
Yeah, good morning to you, Maddie. That's right. President Trump again calling on Fed Chair Jay Powell this morning to preemptively cut interest rates. This just days after the president called for potentially ousting the central banker. The president posting on social media on his Truth Social site this morning that, quote, there can be a slowing of the economy unless Mr. Too Late, a major loser, lowers interest rates now. The president pointed to how Europe has already lowered rates, quote, 7 times, and that Powell has always been too late. Trump stressed that, quote, preemptive cuts in rates are being called for by many, and that with energy costs and food prices down, there's virtually no inflation. Now, these comments top a days-long worth of tirade coming from the president, lashing out last week against the Fed chair following Powell's remarks that the president's tariffs could lead to higher inflation and lower growth, and that the Fed would hold rates steady for now. Trump said that Powell's termination cannot come fast enough and told reporters in the Oval Office that, quote, I'm not happy with him. I'll let him know it. And if I want him out, he'll be out of there real fast, believe me. Now, over the weekend on Sunday, Chicago Fed President Austin Goolsbee told CBS's Face the Nation that trying to remove Fed Chair Powell early would undermine the Federal Reserve's credibility. Steve Moore, a longtime advisor to the president, told me on Friday that every time he goes to see the president, Trump complains to him that appointing Fed Chair Powell as the Fed chair was one of his biggest mistakes. He handicapped the odds of the president removing Powell before his term ends in May 2026 at less than 50-50. He also called the Powell's comments from Wednesday, quote, a partisan rant. Now, whether the removal of Powell could survive a legal challenge is, of course, another question. The law clearly states that Fed members of the board will serve for 14 years unless removed by the president for cause. Now, the law does not specifically address the Fed chair. Of course, the question remains, what exactly constitutes for cause. Now, Maddie, over the weekend, we also heard from a member of the Senate Banking Committee, Republican Senator John Kennedy, who actually defended Fed Chair Powell, telling Meet the Press that the president does not have the right to remove the Fed chair and that the Fed ought to remain independent. Back to you.
All right, Jennifer, thanks so much. I also think it's interesting to note that Treasury Secretary Scott Bessent has previously said that it is important for the Fed to maintain its independence. Of course, we'll see if that ends up holding true here. Well, central bank independence and trade will be front and center at the IMF and World Bank spring meetings kicking off in Washington as global economic and finance chiefs grapple with the worst global trade crisis in nearly a century. Joining us now to discuss the global economic outlook, we've got Kevin King. He is a senior international economist and head of Vanguard's global economic research team that develops its long-term and cyclical economic outlooks. Kevin, great to speak with you this morning. Talk to me about where things stand today with your outlook on the economy if we do continue to see this pressure on the Fed chair potentially lead to some sort of termination.
Yeah, thanks for having me. Good morning to you. So that's a really interesting question, and I think our approach is that we take one step at a time at this point, and we take those cues from the series of tariff developments that we've seen thus far. The Fed chair, I think, made his commitment to the dual mandate very clear. And I personally thought that he couldn't have made it clearer last week at the Economic Club of Chicago. Mm-hmm. So our view remains that the dual mandate that he is committed to and he articulated really remains the sole goal and job of the Fed. And the balance of the economic situation is such that we are about to see, there's a very high likelihood that we are about to see price increases. And unlike the 2018-19 tariff situation, when most of the tariff was placed on China, the current situation is such that the tariffs are happening really all at the same time across all kinds of goods, not just intermediate, but final goods with, effectively most of our trading partners. And that is a situation that really is different from 2018-19. So the inflationary pressure will be tremendous going forward, especially into the second quarter. And in the face of that, we just have to remember what it was like in the 1970s, where we had a very severe adverse supply shocks that caused the great inflation. And the lessons from that period, where when the Fed vacillated between the price stability and full employment, that decade did not end well from the full employment and economic growth standpoint, and also its implications for the financial markets.
Yeah.
So that remains our view.
Yeah, and Kevin, in just about a minute here, obviously the stagnationary period in the 70s leading to a recession. What is your base case for the likelihood that high inflation mixed with lower growth could lead to a recession this time around?
Our view currently, again, we're taking one step at a time, but our view currently is that we're going to see a significantly softer economic growth this year. And our forecast for now is it's going to be somewhere between 0.5 and 1%. Roughly 0.75% growth in the U.S. But again, the variance around our forecast is unusually large, and we're in the state what we would call dancing with recession. So recession may not be our baseline, but we're very close to that in the current state.
And Kevin, my guest host Ann Berry has a question for you as well. Ann.
Kevin, talk to us about what your thoughts are on the weakening of the dollar that we've been seeing in recent weeks. Where does that lead us in the near term?
In the near term, so we would put that, there has been a lot of chatter about, what does that mean? The disconnect between rising treasury yields and the weakening dollar. The current thinking is that that at the minimum reminds all of us that the world is watching whether U.S. is going to continue its role as a provider of reserve currency and provider of stability. Really in times of crises and instability. And to the extent that the U.S. is indicating some sort of a regime shift, what that regime is going to be like. So in the long term, and we're not anticipating the role of reserve currency of US dollar is replaceable. That's a given. The entire international global trade and finance system runs in US dollar. So in the long term, that is our view. That said, in the short term, we're seeing pressures, and we're certainly seeing question marks coming from just the market's reactions. And on the margin, that certainly could put further downward pressure on US dollars.
And talk to me, too, about where you see the most growth globally, Kevin, because investors are seeking safety outside of the U.S. right now, and I think they may want to follow countries that have stimulus and potential growth opportunities moving forward. So in your final 30 seconds with us, which of those countries abroad do you think have the most growth potential this year?
Emerging markets actually, interestingly, have come out, more in balance, and they actually have done a better job taming inflation ahead of the curve, I would argue, than a lot of other developed economies. So they're actually entering into this phase in a better shape than you otherwise would have expected. That said, if this growth scare or concern about recession turns into something greater and darker, gloomier, then that obviously has global implications. So I don't know if I necessarily have an optimistic answer to that question.
Yeah, but that's fair enough amid all of this uncertainty. Kevin, thank you so much for joining us this morning. Really appreciate it. And thanks to our Ann Berry for joining the conversation as well. Nice. Coming up, what the post-tariff Mag 7 sell-off could mean for the broader tech industry. We'll get you that information next. Stick around. Earnings season about to kick off for the Magnificent Seven. Tesla's going to kick things off on Tuesday. Alphabet coming up on Thursday. Amazon, Meta, Microsoft, and Apple will all follow next week. Investors will be watching closely to see if mega-cap tech's AI investments are paying off. I'm still joined here by Ann Berry, the founder of Threadneedle Ventures, a 15-year veteran of private equity deal-making. And curious to get your thoughts. Obviously, all of the Mag 7 members down this morning, taking the broader market with them here. How high is the bar this earnings cycle for them?
I think the bar's different for different members of the Mag 7. And you and I were talking in the break. Tesla, frankly, of all of them, is the least interesting one for me in terms of earnings. I think the Tesla has become such a meme-ified stock at this point that I'm not looking at that one for signals as to the underlying strength of AI spend or the underlying returns on some of that CapEx. Alphabet, on the other hand, Microsoft, on the other hand, Amazon, on the other hand, watching those super closely. And I think the bar is going to be higher than it was before. Because I think in this environment where we've got macro uncertainty, we've got policy uncertainty, we've got tariffs overhanging us, I think the market is going to be desperately looking for tangible signs of real return on investment now, whether you're a manufacturing business, whether you're a retail business, but particularly for tech, where these CapEx budgets have been so inflated for so long. This is the kind of time when people are saying, show us the money, guys, because we need to see tangible outcomes in a world this uncertain.
And how might that play into any type of commentary around AI CapEx? Do you see any type of restraint coming in about spending right now, given the tariff concerns?
Well, we haven't so far. What was really interesting, right, in the height of that post sort of Liberation Day shock and horror when everyone was like, how did we get here? We saw a couple of the big tech names saying, no, we're still going all in on our AI CapEx budget. We're not shifting gears for 2025. I think that may change. Right? And I think if there is bad news to come, it's going to come out this earnings season. If you're a management team and you're smart, if you've got signals you need to send in the market, you want to get lost in the noise, now's the time to do it. And I do think if there's going to be a tapering of CapEx, we'll start to see signs of it this earnings season.
All right, Ann, thank you so much. Really appreciate it. We're going to switch gears a little bit here. In the past quarter, KPMG found that AI and software continued to dominate U.S. venture capital spending in the first quarter, driven by major deals for OpenAI and Anthropic. But could tariff-related uncertainty put those investments at further risk? Here with more on the tech sector, we've got Cameron Ansari. He's the managing partner of Capital Ventures, former principal and venture partner at Greycroft, also formerly with Pinterest. So Cameron, you've got a great overview of the tech space more broadly here. We've obviously seen the Mag 7 shedding money from its stock and market cap basis here. How much conviction do you have in tech investments right now?
So I think, the tech investing space is not a single monolith, right? And the venture space, where I spend most of my time, is also separated between early stage, seed and Series A companies are just starting, business plan, a couple of guys kind of getting together and creating something from scratch, versus the Anthropic, OpenAI deals that you see that are major outliers, right? Those are extraordinary one-off companies and very late stage and established. I think OpenAI said they have like $3 or $4 billion in revenue or something. These are not startups anymore. So the early stage investing market has not really been impacted yet. Seed stage investing, which is a horizon of, let's say, 7, 8, 10 years. People are not saying, I'm not going to do a great seed deal now because I'm worried about tariffs. But I do think the later stage is deeply impacted, particularly the IPO pipeline now being totally clogged and essentially at a pause, a standstill.
How do you anticipate that pipeline being impacted by these tariffs a little bit further out?
The key word is uncertainty, right? I think Ann touched on that as well. I mean, uncertainty is what the markets hate. And there's so much uncertainty right now around interest rates, around policy, around the Pope passed away this morning. It's like there's so many things going on. It's like the last thing we need, and so all of that uncertainty I think leads to cautionary investing style, and I think that's also led to Klarna, StubHub, all these companies saying, look, it's not a good time for us to come out, and because of that, you really have a lot of pausing in the overall cycle.
And what about sort of deal doing outside of IPOs, Cameron? Strategics are still sitting there with quite a lot of cash relative to historical levels. Do you think they're going to step up? Are they going to start going bargain hunting now and start buying out some of these VC-backed businesses?
We thought that would happen. When this new administration came in, there was a thought there's going to be renewed M&A activity, a more friendly environment towards deal making and less scrutiny in terms of antitrust. You saw the Wiz deal announced. I mean, that's the biggest deal I think that's ever happened in the venture space. I'm not sure if that's closed or if that's going to go through some kind of process. So, you always kind of wait to make sure everything's done before it's done. But because we've seen things like Figma fall apart, we saw the Visa deal for Plaid not happen, et cetera. But deal making has not picked up either, right? Because I think, again, the uncertainty is so prevalent that the only firms I see doing actively looking at deals are private equity funds that still look for great software companies with recurring revenue that are affordable in the public market.
And in terms of different sectors, Cameron, where are you seeing opportunity? Are you focusing on fintech? Are you focusing on health? They're sort of areas getting more compelling.
I focus primarily on fintech, as well as some e-commerce and commerce tech investing. Certainly healthcare is a hot area. AI is a mega category at this point that really pervades every kind of deal. I think it's hard to say like I'm an AI investor because AI is sort of a foundational layer now in most categories of companies. And then there are certain kind of spaces like climate is still very active. I see deals in that area. It's not really my focus, but I saw a number of companies last week here in New York doing that type of work. And then crypto is as always, blockchain and crypto deals still are pretty active, and that's an area that continues to see activity.
Have you seen an adjustment in the kinds of pitches that are crossing your desk to accumulate around the tariff risk in the room? Obviously, mentioning AI as many times as possible was a proven strategy. Are you now seeing more mentions of tariff hedging or supply chain issues?
Not really, for the fundamental reason that most early stage venture companies are not companies with components or hardware or real supply chain that relies on kind of cross-border transport of goods. Some do. I mean, in some cases, you may have a component, a chip or something, but the vast majority of early stage venture companies that most funds look at are software. So really, your product is intellectual property and code, which is not, thankfully at this point, tariffed. So not yet, but I think if you're looking at companies that do have a hardware component, that's certainly going to be part of the conversation, no question.
Yeah, absolutely. Well, Cameron, thank you so much for coming in studio. We really appreciate it. Thank you for your insights, too. And also, I want to give a huge thank you to Ann Berry for joining me for the hour. Ann, really appreciate your insights, as always. Thank you for making the time for Yahoo Finance. Let's get you a final check on the markets for our hour here. U.S. stock losses accelerating as President Trump renews his push for the Fed to cut interest rates. You've got your S&P 500 down a little over 2%. Your tech-heavy NASDAQ down just about 2.5%. Taking a look at what's moving your S&P 500, the two biggest laggards, IT and consumer discretionary. Every sector is down, but the best of the worst right now are consumer staples, materials, and real estate. Let's also take a look over at the bond market, continuing to see that bid at the front end of the curve here, and that 2s10 steepeners continuing. You've got your 10-year yield up about 2 basis points, hitting 4.35 this morning. Your 30-year yield up about 5 basis points as well. And finally, let's take a look at the U.S. dollar continuing its declines now under that key 100 level. We've seen the U.S. dollar being down against every major G10 currency this morning as the Sell America trade continues to take hold here. And interesting to also see that the traditional correlations that we see in the market not necessarily taking place. You've got a risk-off sentiment in stocks, but you're also off the dollar, you're off of bonds. So where are you on? We're seeing people flying into gold at the moment. Will that continue? That will be a question that we will continue to cover on our shows throughout the week. Coming up, we've got wealth dedicated to your personal finance needs. Brad Smith has you for the hour.